Hey guys, we're here with Kevin Green on the Commodity Report. We are back. So, oil is down big today. Something to just kind of talk about here first off. Are we seeing this kind of coming into support? Are we seeing this kind of as an opportunity or a major risk out there? I mean, it seems like a danger, and Kevin has brought some great charts to kind of show us this. We caught a nice little pop trade the other couple of weeks. Kevin talked about it. I had a signal in it as well, just kind of a bottoming bounce signal, which worked out well. It was a good trade, but it came right back down. Now it's all the way back at a support zone. So, Kevin, what are you seeing in the oil market? And let me know when you want me to bring up your charts.
Yeah, obviously we had the events that happened on Friday after the market closed here, and we had Israel retaliating with strikes in Iran, but those strikes were very targeted, if you will. I mean, it seemed like it was actually a lot more measured than the street's expectations, and we did not see any type of formal targeting when it comes to oil infrastructure as well as logistics lines. So we did see a selling event taking place, and then we also had Iran kind of respond. Obviously, they're going to respond in kind, like we would deserve the right to retaliate, but they did not actually say that they were going to. So the market's also pricing in the fact that maybe this is going to be it for the tit for tat for right now. Now, obviously, no one has a crystal ball. Anything can happen in these markets. We always have to keep that in mind. But that's why we are seeing, oil move to the downside here today. Now, we did kind of get into a support zone, if you will, and I'm looking at a support zone between $66.50 going down to $65, and I'll say 75 cents, but technically it's 65 as areas of buying pressure to come into the market here. But if you kind of remove the geopolitical risk, it really gets difficult, Jason, when you're looking at the fundamentals of oil right now, right? I mean, we have the growth story here in the United States that's already been kind of priced in. We know the production levels that we have been in. For the most part, actually, they have stalled out, but that's more seasonal in nature. And then you have utilization rates starting to come down here a little bit, which actually could provide a little bit of support if we continue to see this rate to the downside, a little bit of support for energy products as supply will synthetically be taken out of the market. Now, is it going to be enough supply taken out of the market to offset some of the bearish fundamentals that we're seeing on a global scale? I'm not sure. But until China, which is really that core cornerstone theme right now, is going to be the China trade. If you're looking for a longer term growth story, until they actually come out with some really good economic data or they continue to talk about stimulus measures, I think energy traders right now really want to see the numbers being reflected, not just the rhetoric, because we've been burned so many times over the last couple of years when it comes to the China story. It's kind of like a show me first. You're saying a lot, China, you're saying a lot, but we got to see it in action. And that's going to come in the form of industrial production exceeding the street's expectations. That's going to also come into the form of import demand on a volume standpoint being higher than the street's expectations, or at least increasing here. And so I would say if you're taking a tactical position right now for a small bounce, maybe an overreaction to the downside, that could be the case. But I would say that's a scalp move right now. I don't feel a lot of confidence on the longer term view for oil right now in the near term. And I would say over the next 3 to 4 weeks, I think there might be a tactical bounce to play, but you probably will see some fading of those of that bounce in the near term here. And the events over the weekend kind of give short traders a little bit more confidence that they can knock down crude in the meantime. Now, crack spreads have actually improved. So the last time that we spoke, they weren't doing as great. You saw, it's trading at around $17.64. So we're talking about 3-2-1 crack spread, 3 barrels of crude being refined into 2 barrels of oil and then 1 barrel of diesel. There's so many different crack spreads out there, but that's usually the popular one that we see. And you and I have had this conversation over the last couple of weeks, if not months, that crack spread continues to go lower and lower. So the margins or the profitability of those products are getting lower and lower, and it's going to impact a lot of these energy companies, which I said we're trading at a pretty decent premium compared to what we're seeing on the ground. Now, last week we had Valero report their earnings, and that's exactly what they talked about. Margins are getting crushed. Their margin rate was actually a lot lower. Their operating margin rate was a lot lower than the street's expectations. That might have already been priced in. We did see a little bit of a sell-off when it came to the name, but we also have Exxon and Chevron reporting on this Friday. And I think that's going to be another indication if they do come out and say the same thing. Maybe the market tries to sell it off here a little bit, even though I do think that there's some structural support levels when it comes to Exxon. So that's really the crude trade right now. Once again, taking the premium out of it. And I always have to say this too. When we talk about these things, we're here to talk about money. We're here to help people make money, right? And sometimes that comes at the cost of us talking about geopolitical events in a different light rather than maybe that humanistic, right? Like I actually like the fact that maybe we don't have a back and forth from a human standpoint. From a money standpoint, that puts pressure down on crude. So if you're a crude bull, you obviously know that that's going to be a headwind. But if something does ratchet up again, you might start seeing that short covering rally taking place. So that's kind of what I'm looking at. What do you think when it comes to the crude trade or maybe some of the other energy byproducts?
Yeah, I'm seeing it's the same thing you and I have been talking about. One is if we're just looking at crude oil in itself, we're just looking at the fundamentals, we're really not at a point where we would say, hey, this looks great here. Yes, positioning has finally gotten really offsides. If you look at the COT report, we're looking at producers, we're looking at commercials. It looks very interesting. But if that doesn't start to pull off into a way where it starts a short covering rally, it really doesn't matter that much. And once again, like Kevin and I have been talking about for a while, the fundamentals for crude just don't make sense yet. For a big rally, sure, pops will happen. From these support zones, even, maybe you could see a bounce here. Not exactly my play of a trade, but you could see a bounce here. But once again, let's kind of let the market kind of decide what to do here. Really, like, let's see a price breakout. Let's see something change. And I like this chart you sent as well, which was the MACD crossover. And we're still in a MACD sell signal. We did start to see some improvement in that a couple times, we've talked about before, and I know you love this MACD for on a monthly, but we're not seeing that cross into really positive territory. We haven't seen that in a long time. So until we really see that, I would say, hey, we're kind of stuck in this downward trend. There's a lot of pressure on the crude oil market at the moment. Do I think that it's going to last to year end? No, I don't think so. However, it doesn't matter. We're talking about week to week. And at the moment, there are no signals that would say, hey, we're in an uptrend in crude. And at the moment, there are no signals that are saying, hey, this is fundamentally a good buy. And positioning wise, sure, but that can last and get worse over time. So once again, it's a sell, sell, sell signal. So just kind of sit on the sidelines and wait for those to improve.
Yeah, and this chart here, it's a monthly chart. So we have to keep that in mind. So my theme this week, Jason, is let's zoom out a little bit, right? Let's start looking at cycles themselves and see, are we able to glean anything from this? What I get a little bit concerned about with this chart, now this is a monthly, we have to keep that in mind. So we usually on a weekly basis talk about the tactical setup, what could happen that week, or the next 2 weeks. This is more what could happen long term. Now, if that MACD continues to fail, I get a little bit concerned. I have it highlighted there that MACD cross, especially going below that zero line, actually does also then coincide with some heavy selling pressure. Doesn't mean that it's going to happen today. Doesn't mean that it's going to happen next week. But the longer term trend kind of suggests, hey, we might be in for a little bit more of a dip. And we may be just flagging out like the last month and a half, or not month and a half, last year or so. Maybe we have just been flagging, and now we're going to complete that trend on the downside, and maybe we do hit 40. I don't know if that's going to be the case yet, but once again, I'm a little bit concerned about the price action. I would also say too, those crosses coincide with also equity pullbacks. The only one that really does not coincide is going to be that 2013-ish area. 2013, 2014, middle 2014, where we kind of had the OPEC impact of flooding the markets and trying to kill off shale, right? And like but actually, if you look 6 months after that, we had an equity pullback. So it's not an equity show, but this is something that I do utilize as a barometer and a very key gauge here. Does that mean we go in an economic recession? I don't know. Maybe we are in a soft landing, but the trajectory doesn't look really good. And you want to start seeing that, MACD starting to level out, at least that 12 period moving average. So that's the 1226 EMAs. That 12 is in blue, the 26 is in yellow. So keeping this one on my radar. I'm not saying I'm like a uber bear on crude for right now, but I can tell you that hinge lower, it's like we need to get buyers here. If we don't get buyers here, I do fear that we will see somewhat of a dramatic pullback. Now, we're not going to go to the negative. That chart also shows, crude forward contract hitting $6.50. I don't think that's going to happen, right? But you could see maybe a value area at around that 45-ish level kind of come into play here over the next year and a half, if the fundamentals just really don't give us the strong catalyst. So I'm more of like if we're looking at a cycle, I'm more just on this chart right now, more downward pricing pressure potentially rather than upward pricing. Monthly chart. Have to keep that in mind, because somebody's going to watch this and be like, oh, you're massively bearish on crude. No, I'm just saying I'm a little concerned about the longer term trend. But there can be, and as we see in these charts, nice swings to the upside. I mean, this chart also coincides with, this flag, if you will. You actually kind of a head and shoulders pattern. Now I look at it. Also includes oil going up to $95. I mean, if we had crude from 68 to go to 90, that's a hell of a move. All right. So longer term view, but I thought this would be nice to bring to the attention of others and really just kind of stress the China impact that this is going to have, the Germany impact that we need to have as far as bullishness and economic expansion stories in order for us to be able to sustain these prices. Because I think that the U.S. side of growth is already being priced in.
Yeah, and another thing to look at on these charts, and once again, zooming out is incredibly important, and something I do a lot here and we talk about a lot is kind of the ability to zoom out and tune out the noise. And so if you guys also make sure to subscribe to us, make sure to go to YouTube, hit the notification bell, hit the subscription button. We've been doing these once a week for a long time. You can go back and check all of our work. There's a whole playlist on it. But one thing I like about this chart, Kevin, that you brought today is if you look at the MACD, and there's one thing that is bullish about it, and it goes to your point, which is if it holds here, which is incredibly important. So I'll put the bullish case and I'll put the bearish case. So first, the bullish case. There's higher lows on the MACD. I've seen that a couple times on a couple different commodities over the years, and most of the time when you kind of see that, like you saw the divergence in 2020, that led to a massive rally. You see this higher low kind of thing right here. And if we really held this level and took off, I think it would be a very positive sign for crude oil. Now I'll give you the bearish case. So when you look at MACDs, if you're a technician like myself, we look at things like moving average signals, and we call a MACD kiss right here. So if you look at the moving averages, basically that moving average, the blue line hit the yellow line. I think that's yellow. My colors are kind of blurred from time to time. So it looks like teal and yellow. And so you look at that MACD basically hit the top of that and then bounced off lower. So usually that's a MACD kiss. That usually is kind of, you can call that a kiss of death when it's going to the downside. And right now that could be a kiss of death pattern. So either this is going to work out one way or another. And once again, this is the thing about trading that people hate. Oh my gosh, you guys are bullish and bearish. What is that about? You guys are crazy. Well, I'll tell you what. It's important to be bullish and bearish. One is you want to have both sides of the story, and you want to be able to trade it both ways. Right here, if a breakdown happened, that's an amazing pattern to trade. A breakdown would be an amazing sell signal. You can make a lot of money shorting commodities generally. It makes you a lot of money. Also, if it started to hold up here, and then we started to take out some of these major levels, like Kevin said, we could possibly make a move to 90. That's a big move. So once again, you want to be able to look at it both ways here, but I think that we've really laid out both cases for crude oil going forward. So let's jump into natural gas, which is another wonderful chart that you brought. Natural gas right here, looking, you got a pennant pattern. You got a MACD cross the other direction, looking really interesting. So what are you seeing here, Kevin?
I can't believe I'm going to say this. This looks bullish. And that's a tough thing to say. Once again, this is a monthly chart, guys. So that's an overall. So when we utilize monthly charts, especially when you're talking about commodities, you're looking at, we call them like cycles, right? When are we seeing cycle highs? When are we seeing cycle lows? And we are seeing actually a really bullish, cross that's taking place right now. I also have a couple of other things in there. Right? You have this kind of like a pennant, inverse pennant formation. Right now, you're hitting some structural lows once you're getting near that $2 level, $1.90. We saw, I believe, go down to what, 165 this year, if I'm not mistaken. You're hitting some structural lows. That downtrend on that channel is still for the most part intact, but I actually did adjust the last, let's say, 3 years or so, 4 years, where it's starting to flatten out there. So maybe we are seeing a bottoming formation. But once again, if we look at those MACD crosses that we have here, usually I haven't seen one cross that doesn't coincide with a pretty decent or a substantial move to the upside. Now, if I'm looking at this from a technical standpoint, if I wanted to be conservative, 12 over 26 EMA, this is a monthly chart. If you want to be conservative, 410 could be a spot where we do hit. That coincides with that channel line that I have, right? That coincides with that cross level that we do have on there. And that would also then kind of coincide with this like RSI that's really trying to make trying to make higher highs after the initial bottom that we've had over the last couple of months, right? So that's kind of how I would utilize this chart. If we see over the last couple of times, $4-ish has been our area of resistance. So I'm keeping my eye out on that. What does that mean though? What does it mean for it to hit $4 where it's trading at right now? I mean, you're talking about another $1.70 move to the upside. On a one contract basis, that's a lot of money. So, that could actually change some things up. And then you also have the seasonal aspect of it. Going into the winter months, we should be drawing on inventories. If Europe does have a little bit of a harder winter, it's always it's a question mark. We're not weather meteorologists or anything of that nature, but if they have a harder winter, maybe they draw down inventories a little bit more. We are seeing an increase of supply when it comes to LNG tankers. So that actually, I think there's like 2 or 3 that are going to be, in use, right, over the next couple of weeks. And if we do have that capacity for LNG, then that can give you the bull case for natural gas, because once again, LNG is still on a relative basis in demand, once again, relatively compared to the gaseous form. So it allows us to be able to have a little bit more of a stronger base when it comes to exports. So it's a tough market. I wouldn't say like go in just completely like buy one contract and let it sit. This is one of those situations where you can look at longer dated calls and do diagonal spreads on them. So buying a longer dated call, selling near term calls against it to try to like reduce the premium on that longer call. And until you get that spike, that's how you can kind of leverage it and offset some of the time decay that you're going to have with natural gas. Fundamental case, we still have a lot of it. Right? We know that a lot of money managers like to fade it, but it's an interesting cross that did come up on my radar last week. Unfortunately, we weren't able to do this last week, but this is something that I am keeping my eye out on, because once again, you go back, you can kind of see what happens usually after we see that cross.
No, I like that. So what are you seeing well, let's flip it a little bit. In the natural gas market, what's the bear case then? If we're talking about the bull case, and there's a lot of things that are bullish about it, what's the bear case for natural gas?
Things remain the way that they are right now. Look, we have so much that we have to flare it out. Like some of it, depending on where you're at, especially if you're looking at like North Dakota, it's just not profitable to sequester it or to put it into a pipeline or build out pipeline infrastructure. Now, on the other side of that, a lot of these natural gas players in the space are trying to reduce CapEx spend, so that could probably even constrain supply in the near term. And then there's also this thought, and I don't have a thesis on this yet. I'll have to do more research. There is a thought that maybe Permian production kind of I'd say stall out. People have been saying that for the last 4 years, 5 years. Technology improvements have really improved efficiency for a lot of those new wells or rigs, and that actually has an impact when it comes to natural gas production as well, right? As you frack within the Permian, it's not only the extraction of oil, but you're also able to tap into natural gas resources. So if you do see that narrative of Permian Basin starting to stall out as far as production rates, that'll also tighten up the supply at your bull case. Your bear case is, once again, everything stays the same. Mild winters here in the United States, mild winters in Europe. That could dampen LNG demand. You also have the case of competition coming out of Saudi Arabia and maybe some other players that can actually supply the Middle Eastern and Northern African regions rather than the U.S. shipments going over there. Could you have demand kind of shifting from China utilizing our LNG resources? Does that shift because of geopolitical like there's a lot that's there, but I do believe that the longer term story of LNG itself over the next 5 to 6 years is still intact because it just takes so long to get other infrastructure in place. It probably will deserve a premium. So like I said, do I think that Natty is going to get to like $12 to 13? No, but I think that it's a conservative call to say that cross could probably get you up to $4, at least hit you in that upper channel. Actually, probably get you higher than that, but that upper channel would be the conservative bull case for Natty. And with the weather seasonality that we have right now, this would be the bullish time for natural gas if you were to make a play, right? So you have, we'll go back to the catalyst, into the structure that I usually figure out, right? What's going to be that fundamental catalyst that's out there? What's the technical catalyst that is out there? And then what's the spark? We have the technical catalyst or the technical setup that's taking place right now, right? You have the fundamental thesis of maybe weather events. You have the increase of LNG shipping units increasing, right? That will give us a little bit more capacity to export LNG. That's your fundamental catalyst. You got your technical catalyst that we have right here. What's the spark? Your spark could be the seasonal periods of the winter, where you get into, maybe not so much right now, but once you get into that late December, January region, we start getting those Arctic blasts and things of that nature. That's probably could be your start of a short covering rally, and then maybe people actually starting to look into this. And then if we have earnings announcements coming from a lot of these players like EQT and things of that nature, if they come out and they say, yeah, we're going to still constrain our CapEx spend in the amount of rigs into 2025, that could also be your bull catalyst there.
So when we're looking at, speaking about being bullish and speaking about things that could be at turning points, what about the grains? We're finally seeing that the grains started to get up and over some major moving average support. They're finally starting to look like they're bottoming, but they really haven't gone anywhere ever since.
Yeah.
So do you have any thoughts on the grains that, this is a good time to buy? Because seasonally, it's very similar to natural gas. We are at a kind of a sweet spot. We do see these things kind of tick up around these times, but also we see that the cattle has putting so much pressure on it as well. So do you think the grains like corn, wheat, soybeans, these have anywhere to go at the moment? Do you think it makes any sense for people to be buying these things, or do you think that it's going to kind of continue to just be under pressure for a while?
Yeah, so the grains are a very tough trade. So let's give a little bit of a backdrop, since we haven't done this in about 2 weeks, right? So we're in a harvesting period pretty much across the board for the major grains in the United States. You have winter wheat. We're sitting at around 73% fully harvested right now, or through harvest right now. We're ahead of what we saw last year, where we're actually pretty much at the average where we were at last year, and a little bit below average when you're looking at the 10-year average for winter wheat. But when you start getting the corn, we've accelerated the harvest. So we're at 65% harvested through the major players. This time last year, we were only 55%. 10-year average, 50%. So if you were accelerating the harvest, you're going to have more supply hitting in the market, right? You're going to need more storage capacity. And we're still trying to burn off, right? The existing stockpiles that we had last year. That makes it a tough trade. Soybeans, 81% done when it comes to the harvest. This time last year, we were at 72%. 10-year average, 65%. Bear. That's a bearish case. You have the harvest taking place as well as producers shorting to be able to lock in prices. Once again, you have flows there that are going to be negative. Those are structural in nature. Bearish case. The bull case there is once they're done with the harvest, they'll unwind those contracts, right? And so you'll get a short covering event. But I'm not sure if it's going to be enough to kind of push prices higher. And then you have this question mark about South America and what that's going to do. Now, we've been thinking about like El Nino, La Nina. We were expecting these type of shifts or massive shifts in weather earlier this year just never happened. Now there's the case of maybe it's going to happen in the wintertime or in November. Who knows, right? Once again, another one of those boy who cried wolf type of scenarios where it's like you got to actually see it rather than trying to anticipate a weather event. Makes it very difficult. So we have enough supply that's on hand. Now, we are seeing a ramp up in exports for corn and soybeans over the last 3 weeks, 4 weeks. That's good. That's going to be your first tangent here. We're talking about the China story. What are we looking for the China expansion story? Industrial production, increase in oil imports and petroleum products, an increase in imports for grain products as well. All about consumption. There's a definite trend there. So if the import of those, our export numbers go up, their import numbers go up, and they're importing from us, that can kind of thin out some of that old crop supply that's in the market. But it really does kind of get tough because you're in a seasonally low period right now. Geopolitically, I feel like it's also kind of a little bit difficult right now. Now we'll have the elections, and this will be a major election player, guys. So just be mindful of that. We do have elections coming up next week, Tuesday. And let's say that we do have a Trump administration out there. I would not be surprised if you continue to see downward pressure on the grains. Right? The thought process is that we probably will see some form of a concession or lack of support for Ukraine when it comes to military assets. And if that's going to be the case, most likely probably seeing some form of a split within that country. And once again, that's going to probably give grain bears a little bit more confidence that, hey, the risk of logistical lines kind of getting impacted because of this event, Black Sea and all of that, could probably put some downward pressure, especially if you're looking at wheat and if you're looking at soybeans. So fundamentals bearish. You could try to take a stab at it. It gets a little bit difficult here. If I were to be a little bit more confident, and it's going to sound a little bit crazy, but you find buyers stepping into soybeans at around 900 to, let's say, 850. So you still have a little bit of a way to go. We're trading at 988 and a quarter right now. If you're looking at corn, kind of a similar situation. You start seeing buyers really stepping in at 350. We're trading at 410 right now, 412 in this really crazy triangle formation that has taken place, right? But if you were to have some confidence, probably 350 is where you start getting those that are shorting to cover, as well as maybe new buyers stepping in. For wheat, and I think wheat probably has the biggest opportunity out of all of them, just because of the structural dynamics within that product. You get buyers stepping in at 500. We've already had that happen. In August, we had that happen, right? So if you go back, retest, you want to see some buyers kind of stepping in, boom, move higher. If not, and we fail, you're looking at 400 and some change for wheat. I would say the technicals say bearish, fundamentals say bearish. You're getting close to support though, right? So if you are a new bear trying to get into the space, I would say be cautious with it. If you're a buyer of this space, I would say also be cautious with this. You probably still have a little bit more downside action before you kind of get a base there. And if you can stomach 100 cents lower, if you could stomach 100, 150 cents lower for a longer term trade, you probably could do some damage there to the upside. I'm just not sure if you want to take that stab at it. And you could probably just utilize options in order to do so. Maybe not even long the contracts, just getting into call spreads. Or you can, even sell put spreads too. And this is not something that's really recommended. And I don't recommend anything on here, but you could also look at selling in the money put spreads, which would give you a little bit more credits on the sell, but you're still going to need to have a move, right? Mm-hmm. And so it doesn't really give you that advantage when it comes to time decay, but it does give you the ability to at least have a smaller outlier for the trade a little bit more. And still try to leverage a little bit of theta decay rather than maybe go and bull call spreads, even though bull call spreads will allow you kind of a lot more upside potential. You can take off the short call at any time if you start seeing like a trend developing.
No, that's a good point. And the one thing I did want to add was wheat. Wheat, if I was to guess one, and I guess it's also, I'm speaking my book, it's the one we're long. It's the one I like the most at the moment. It does have a seasonal sweet spot. And it's interesting, which is something you and I can kind of talk about, Kevin, a little bit too. Is when you look at the seasonality of some of these grains, it's very similar to energy. When you're looking at oil and gasoline, everybody says, that once you're in the summer period, that's when the driving period is, and that puts pressure on gasoline prices to move higher. And what you find in seasonality, that's usually wrong. And the reasons are pretty well known. Like I'm sure you could speak on it even better than me, Kevin, which is, once more supply coming onto the market, as demand coming onto the market, and so on. But if we're looking at wheat, it kind of did the thing it was supposed to do. It had a nice rally in August to September. Now we're kind of in this zone where it's either a make or break point. I do like wheat out of all of them. If I was going to pick one, there's a lot of interesting news coming out of Russia that could also put more pressure on wheat prices to move higher. But just like Kevin said, if you're looking, Kevin, see, I'm speaking of it more of a long-term angle, and Kevin's speaking of it more tactical. So that's why I think this works really well here. Is like if you're a more tactical trader, you have someone who can speak to those levels very quickly. If you're a more long-term trend following guy like myself, I speak to more of that most of the time. But if we're looking at wheat, I would say that's the one I would be picking up. I think the rest of them, there's still some pressure on them in a lot of different areas. What do you think about any of the other ags or softs? Are you seeing anything out there that's making sense to buy? I am looking at, sugar had a nice false breakdown signal the other week. That's continued, but now it's moved pretty sideways ever since. Hasn't done much. What are you seeing in the softs market, Kevin?
Not so much for the softs, man. I mean, I will be completely honest. I haven't really been following the softs like last week. It's been a crazy week there. What I would say for what I do know is that for cocoa, it's been in an interesting range, right? And it looks like it looks like it wants to fail, but it hasn't yet. Last time that I checked, but I think that the thought is that they're going to have we're going to see a better than expected. Better than expected weather conditions, especially if you're looking at Ghana and the Ivory Coast. I think that's really the bear case, is those two locations really, getting what they need in order to kind of boost up production levels. And then you're starting to see kind of the re-implementation of a lot of new contracts being put in place for 2025 for physical delivery. But a lot of those markets, they're tough because they're thin and they can shift on a dime. But I don't know. I feel like the cocoa story is done. That's just me. Like, I feel like there's still some remnants of the speculators that are still trying to get one more push out of this whole thing.
One last hurrah.
Yeah, I feel like it's I mean, honestly, I really do. I think it's just one last hurrah outside of, once again, you have weather events and weather patterns, and that's how you're trading those names. Cocoa, coffee, same way, right? Like, those are usually going to be weather plays, especially in the winter months. So it makes it very difficult. Outside of those softs, though, I don't really have any other real commentary to kind of provide there. Do you have any other insights that you can see?
Oh, yeah. I mean, for me, I think there's a bunch of really interesting setups. I'm going to go over a bunch of them on my Substack actually today. I mean, lumber is in a major squeeze pattern. So you have this major Bollinger Band squeeze pattern. These don't happen all the time. And usually when we see this, we see a nice move. I know not a lot of people out here trade lumber. The LBR contract is actually a lot. The LB contract was extremely thin. The LBR contract actually has some liquidity. So you could look at trading that, but once again, it's futures, it's lumber. Know what you're doing if you do take that. That's not advice from me. It's just something you could do. Also, coffee. Coffee has a very interesting one, and also if we look at seasonality for coffee, it looks really good kind of coming into year end. So most of the time we do see a nice boost in coffee coming into year end. It's hanging out at those all-time highs. Remember, Sam brought that chart for us a long time ago.
Mm-hmm.
Which is a chart of that long-term pattern, basically getting close to all-time highs and possibly breaking out to them at some point. And we're really looking like we're getting there on coffee. However, the commercial positioning is extreme. Like the positioning from commercials to large traders or hedge funds or speculators it looks pretty bad. So once again, I'd wait for a breakout and possibly an unwind of that positioning, and maybe that'll kind of help to boost it forward. But really here, I think coffee still looks good into year end as possible trade. Sugar, I like sugar. I think sugar is probably the best play in the space if you're going to take advantage of something in the soft space. Orange juice is another one that's just been raging that nobody's ever talking about. And so, but
Yeah.
I know nobody trades it. So it's I'm one of the few people who trades that contract. It is actually a liquid contract, but not a ton of people trade it. And finally, cocoa. To add to what Kevin said, and funny enough, Sam Gatlin posted something the other day about I think he wants to get long cocoa at the support zone where it's at. I believe just like you, where I think you and I have seen commodities over the years, and to me, when I take a trade like that and it's long cocoa or something along those lines, and it does a really good job, and it goes parabolic, and I get out of it, I really don't try to look back at it.
It's hard to. It's when you have those breakouts. I feel like there's sometimes we get maybe equity traders are like, oh, it did it before, it can do it again. It's like, be careful with that. I mean, sometimes you can, sometimes you do see a price move, but it's like a bunch of speculators that are trading amongst themselves, right? Like we try to find areas where you get the speculators kind of come in last, right? Those are the ones that we see that follow through. But what's going to get producers into this? What's going to get institutional positions kind of either caught off sides or what have you, and it just seems like that one's a difficult one. But once again, it can change. Things can change on a dime. I am going to send you two charts here. I'll kick it back over to you. I didn't mean to interrupt you.
Oh no, you're good.
Two more charts, then I do it to Jet here. But yeah, go ahead, and I'm gonna send these over here to you because I actually am seeing something that is bullish.
But yeah, I do think for me, here's the biggest thing that I think is the most important thing for everybody to take home with them today is we have an election coming up. With the election coming up, I think it's very easy to go, okay, well, I have some money on the sidelines. I'm ready for the next trade. I like the positions we're in. We're gonna like the way I trade. I'm gonna keep the positions we're in, but there is cash on the sidelines for new trades. Usually elections have great setups, and when these great setups come in, that means that you can be ready for the next move in the market. Because most of the time elections, they're either going to, like oil right now, either the election's going to take oil lower or the election's going to take oil higher. So most of these things that are range bound, the range is usually resolved after an election. So I think for me, that's what I'm looking for. Cash on the sidelines, be ready to deploy it, take it any which way it goes.
Okay, can I? You just brought something else in, and now it's like, I want to talk about that real quick. Let me send this over here to you. Are you able to pull up a lean hog chart by chance?
Yeah. Yes.
You can or not. Let's bring in lean hogs. So lean hogs, that's the pork trade. I do believe that there's actually a pretty decent setup that is taking place here. We have seen prices. Now, we have to keep in mind, too, when you're looking at lean hog futures and you're looking at continuous charts and you're like, man, how erratic. But they have seasonal periods of lows and highs. So we have to be mindful of that. You see the same thing when it comes to cattle. Same thing when it comes to rough rice, which no one talks about or trades on, but even natural gas for that matter, you'll see some of that range bounce. But there is actually a pretty decent setup that's taking place here, and I just sent you over those charts. And I'm going to try to break this
on lean hogs.
Bring up a weekly. That's fine.
Weekly, okay.
Yeah, bring up a weekly. I'm sorry. Probably should have brought up. Yeah, weekly's fine. 3 years. Okay, so we're now in like a little bit of a structural downtrend when it comes to lean hogs. But the reason why I kind of bring that up, you did see some buying support sitting at around 75-ish, give or take. We're trading at around 79.90 right now. But we are going to get into a seasonally low period when it comes to slaughter, right? And so if that's going to be the case, Slaughter rates usually reflect demand in the market. So let's like also keep that in mind, right? So when you have lean hogs, you look at slaughter rates, that reflects demand. And then you look at cold storage, which cold storage numbers come out from the USDA on a month-over-month basis. And you look at how much is in cold storage, you look at the slaughter rates, right? And we're going to see a pretty decent drop off here. But you could make the case that, hey, if we do see a drop off and we also have weights kind of dropping to the downside as well when it comes to the hogs, then you could actually have maybe a structural bull case to be made for these contracts. Now, this is kind of something that's going to set up over time. You could see exactly what happened in November of last year. Kind of saw that bounce to the upside. I'm sorry. Actually, end of November, consolidation period, bounce to the upside. Same thing that we saw in 2022, consolidation kind of bounced to the upside. So usually we kind of overestimate the bearishness when it comes to hogs. And I think right now we do have an area that we could be testing on. I also sent you another chart too, just showing you the seasonal patterns. This is not mine, this is the Hightower. Weekly hog slaughter trends, and this shows the trends going from this year, which is going to be in red, last year, which is going to be in blue, and then that 5-year average. We're basically going to range out until we get to latter half of November, then boom, massive drop off when it comes to slaughter. That could be kind of that initially going to be bearish, but kind of flushes out the supply. And then that's where you kind of get that bullish run going into the end of the year. And then you also see a massive drop off because you have the holiday season and things of that nature. So that's one. Same setup is going to be for cattle. Cattle is kind of interesting though, because it's in a really, this is a hard one to say. This is actually a really nice consolidation pattern. You're looking at live cattle, and we have this like ascending triangle that's taking place, and we're basically touching the upper end of that triangle right now, sitting at around 188 and 3/4 right now. I would say probably maybe a little bit of a pullback coming back to 180, and then let's see if it's going to have enough to be able to break out even higher. But this is actually a very bullish chart when you're looking at live cattle. And then going back to that scenario, we will see lower slaughter rates. We have inventory kind of getting pushed through. We might even have some bird flu ramifications that are taking place as well. And this could still be a bullish trend for cattle for now. But cattle chart kind of consolidating once again. I don't know how much further it can go from here, right? And this is kind of one of those inflationary indicators, but this is setting up for maybe a consolidation breakout. And if not, and if you do have a breakdown, you look at a breakdown below 165. Last thing I will say, election-wise, a lot of things are being priced in. I think, I'm going to piss people off with this. I think the market has overdone their election expectations. Let me just say it like that. I would say that bullish, I feel like this setup is actually bullish for crude. Going into next week, I believe by Saturday of next week, we will have an election winner, if not earlier. We do have some changes when it comes to Pennsylvania, and they should be able to get through a lot. And if it comes down to Georgia, that might be an interesting setup. But I think the crude trade right now is already pricing in one administration coming into power to put pressure on supplies or increase supplies. And that supply is not going to be domestically driven by any stretch of the imagination. It will come from the Middle East, just like we've seen in the first administration. But if we do get a surprise, and I don't even think it's a surprise. I think right now there's also some manipulation happening within the betting markets. But if we do get a surprise, I think you probably will see crude pop to the upside. I think you'll see the same thing when it comes to gasoline. These are all just election plays out there for now. I also believe that the bean trade would actually gain a little bit of steam just for the election, right? Short covering that maybe we don't have these tariff wars going between the US and China. That's also the reason why we're seeing pressure to the downside. If we do increase tariffs, China stops buying from us as much when it comes to the grains. That's already happening. They increase their imports from South America. There's some pricing pressure that's there. I also do believe if we do have what I believe is going to take place here, it's just going to be counter what the market's pricing in right now. I also do believe that you probably will see the dollar maybe reversing a little bit. And that reversal on the dollar can also give the commodities complex, especially when you're looking at grains and when you're looking at energy products. maybe a little bit of a boost too. And I would say that the initial trade post-election on equities probably fade. I'm gonna get hate mail for that. I'm gonna get hate for that because anytime that you'd see anything different outside of the narrative that's going on right now, people get really pissed off. But I am a data analyst. I follow data a lot. I've been following elections literally since I was 16, 17 years old, doing data analysis on them since I was darn near, a junior, senior in high school. And I can just tell you, the divergences that you are seeing in polling averages right now between presidential and down ballot races is something that would be a statistical anomaly. And anytime that you have a statistical anomaly that's being priced into something, I usually say fade that. And so that's my 2 cents. I'll leave it. I'll leave it there. But that could be your short-term election bounces in the market. Grains catching a little bit of a bid, optimism there. Crude short covering event that takes place. Gasoline taking place, same thing. And then I'm not even gonna throw gold in there. I do think that gold probably would fade, but that's a tough one.
Good.
That trend's so strong, and I
wouldn't fade it, but you might not be wrong on that either. Once again, I like what you said there because literally it's funny. I was just talking about that the other day. The spreads and the prediction betting. I mean, all of these things are just anomalies at the moment. They don't make any sense. So it actually goes right to your point. And once again, for me, I also think either way this looks, because once again, people try to remember this. The Democrats are in office right now. We are pumping more oil than we ever had in history. We have outproduced the world at this point. So once again, it could possibly be either way. Oil could make a bounce after the election, but especially if the scenario comes up as a surprise, like Kevin laid out. So, all right,
guys. I don't think it should be a surprise. It shouldn't be a surprise.
No, but
I think the groundwork has been laid that it is going to be some surprise. And I think that's strategic in nature from some of the wealthiest individuals on the planet. I think that's strategic in nature. We'll keep an eye on it. I appreciate you, Jason.
No, I appreciate you coming on, Kevin. And that's Kevin Green. Everybody, make sure to follow Kevin at KG Bull and Bear. Kevin's always putting out great research. And check out my channel at Against All Odds Research on Substack. It's if you're on YouTube, it's in the description. So, all right, guys, we'll see you soon. See you next week.